What if I told you there is a financial magic trick that can turn a pile of car loans into cash? A trick that lets a pizza company raise $1 billion not by selling more pizzas but by selling its future? This isn't magic. This is one of the most powerful, misunderstood, and game changing concepts in modern finance: securitization. And today on Bankers Bootcamp, we are going to demystify it completely. We'll break down how HDFC Bank is using it to clean up its balance sheet and how Domino's Pizza, with the help of Barclays, cooked up $1 billion deal that has nothing to do with dough. By the end of this video, you won't just understand securitization, you will understand how it fundamentally reshaped the investment banking and where it's headed in the age of AI. Plus, I'll reveal two critical aspects of securitization that almost every other video on this topic misses. Stick around because this is the deep dive you have been waiting for. Alright, let's start simple. Imagine you are a baker. You sell cakes, and to make those cakes, you need ingredients: flour, sugar, eggs. But you have used all your cash for ingredients for the cakes currently in your oven. You have IOUs for customers who will pay you later, but you need cash now to buy more ingredients and keep the bakery running. What do? You can't just wait. So you take all those customers' IOUs, bundle them together into a cake IOU package, and sell the entire package to a group of investors. The investors will give you cash upfront. In return, they get to collect the payments from your customers over time. You get instant cash to grow your business, and the investors get a steady stream of income. That, in a nutshell, is securitization. It's the process of taking illiquid assets, things that aren't easily sold for cash, like a mortgage, a car loan, or even future franchisee fee, and transforming them into a tradable security that investors can buy. Now, let's swap the baker for a bank and the IOUs for loans. Here's how the process typically works with all the key players. The originator, the bank. It all starts here. The bank, the originator, gives hundreds and thousands of loans to borrowers. These could be car loans, home mortgages, or credit card debt. Pooling the asset. The bank then pools these similar loans together. Think of it as creating that cake IOU package. This pool of assets is now called as a reference portfolio. Creating the SPV. To make this a clean sale, the bank sets up a special purpose vehicle, SPV. This is a separate legal entity created specifically for this transaction. Its only job is to buy the assets. The bank sells a loan pool to the SPV. This is a crucial step because it moves the loans and their associated risk off the bank's balance sheet to the SPV's balance sheet. Issuing securities. The SPV, now owning the loans, issues bonds known as asset-backed securities, ABS, or mortgage-backed securities, MBS, and sells them to investors like mutual funds, pension funds, and insurance companies. The money from the investors is used to pay the bank for the loans. Credit rating agencies. Before selling these securities, a credit rating agency like Moody's or S&P assesses the risk underlying the assets and gives the securities a rating, example AAA, BB. This rating helps investors to understand the risk they are taking. The servicer. The original bank often stays on as the servicer. They continue to collect the monthly payments from the original borrowers, handle customer service, and then chase down the delinquencies. They then pass these cash flows onto the SPV, which in turn pays the investors. So, the bank gets immediate cash to issue new loans, investors get a new investment product, and the whole system gets a massive injection of liquidity. Modern securitization took off when Ginnie guaranteed the first mortgage pass-through in 1970, unlocking broad investor demand for pool mortgage cash flows. It scaled through Fannie Mae's first CMOs in 1983 and broader ABS in the mid-1980s, evolving into the today's multi-asset market, including whole business deals like Domino's. Now let's see this in action with two massive real-world deals that have just happened. The first, the Indian perspective, the HDFC Bank deal, a strategic cleanup. First up, let's look at the HDFC Bank, India's largest private lender. In 2023, HDFC Bank merged with its parent company, HDFC Limited. This merger dramatically changed its financial picture. Its loan-to-deposit ratio, how much it lends versus how much it holds in deposit, shot up to nearly 110%. For a bank, a ratio that high is a red flag. It signals that the bank is lending more aggressively than it's taking in deposits, forcing it to rely on more expensive borrowing. The bank needed to bring this ratio down, and fast. So what did they do? They turned to securitization. In India, HDFC Bank executed large securitizations of auto loans via pass-through certificates, including a transaction of just over 12,700 crores rated AAA stable with 2 to 6 year maturities. The bank has sold roughly 46,300 crore of loans via securitization in the fiscal year, with the management signaling intent to grow this channel to create balance sheet space for new lending. After the HDFC merger, the loan to deposit ratio became a key management metric, and securitization helps free capital and manage LDR while sustaining growth. Press and rating reports also flagged a 9,063 crores pool as India's largest at that time, showing scale and investor appetite for high quality retail assets. Now let's break down the benefits. For HDFC Bank, immediate liquidity and a healthier balance sheet. By selling the loans, HDFC Bank instantly received cash, and more importantly, they removed these loans from their books. This immediately helped lower its loan to deposit ratio, signaling the regulators and investors that it was managing its risk prudently. Capital for growth. This influx of cash isn't just for show. It's free up the capital that the bank can use now for new loans or fund its aggressive branch expansion plans, all without needing to raise expensive debt. What if the deal didn't happen? HDFC Bank would have been stuck with a high loan to deposit ratio, facing pressure from the RBI. Its growth would have been constrained, and its profitability could have suffered from a higher cost of funds. Benefit for the investors. Access to high quality returns. These weren't just any car loans. They were high quality assets earning a AAA rating from India Ratings. For investors hungry for stable, predictable returns, these securities were a golden opportunity to earn income from a diversified pool of consumer debt. What if the deal didn't happen? Investors would have one less option for steady, reliable income in a competitive market. The HDFC deal is a classic example of using securitization for strategic balance sheet management. It's a win-win that provides stability for the bank and opportunity for the investors. Now the second case study, the Barclays-Domino deal, a slice of the business. Now for our second case study, which takes securitization to a whole new level. This is the Barclays and Domino's Pizza deal. In August 2025, Domino's sold about $1.32 billion of bonds backed by most of its assets, classic whole business securitization, to refinance older debt with Barclays as the lead. The financing also included a $320 million variable funding note facility alongside the term ABS, providing flexible liquidity for the working capital and ongoing needs. Barclays publicly noted it acted as a sole structuring advisor and lead left book runner, underscoring its role in shaping structure, marketing, and investor allocation. Whole business securitizations package franchisee royalties, brand IP, and its system cash flows, which Domino's leveraged to attract a broad base. Reports suggested 50 plus investors participated and demand was strong. Investor enthusiasm showed up in the oversubscription on Chatter. Order books reportedly ran well above the deal size, helping refine pricing and create depth across tranches. Historically, Domino's and peers turned to WBS for lower all-in cost of capital at the price of tight operational covenants and collateral pledges over the core assets. So what are the benefits here? For Domino's Pizza, lower cost of funding. By isolating its most stable and predictable cash flows, Domino's can borrow money at a much better rate than if it had issued regular corporate bonds. Investors love the security of being paid directly from the core operational revenues. Refinancing and flexibility. The primary goal was to repay $1.14 billion of existing debt. This deal allowed them to replace old debt with a newer debt on better terms, strengthening their financial position for the future. What if the deal didn't happen? Domino's would be stuck with its older, possibly more expensive debt. Its ability to invest in growth and innovation would be hampered by a less efficient capital structure. Benefits for the investors. Investing in a strong brand. Investors get a piece of action from one of the most recognizable brands in the world. They are not betting on the company as a whole, but on the strength of its franchisee model to consistently generate fee, a very stable and predictable income stream. More than 50 investors participated in this deal, showing strong confidence. What if the deal didn't happen? Investors would miss out on a unique opportunity to invest in a high-quality, long-term asset backed by the power of Domino's brand, structured by the top investment bank like Barclays. The rise of securitization didn't just create a new product, it completely transformed the business of investment banking. Before securitization, the banking model was simple: originate to hold. A bank made a loan and held it on its books until it was paid off. This tied up the massive amounts of capital. Securitization introduced the originate to distribute model. Now, investment banks are central to this entire process. Their role is multifaceted. Structuring. This is where the magic happens. Investment bankers are the architects of the deal. They help the originator like Domino's or HDFC decide which assets to pool, how to structure the SPV, and how to create different tranches or slices of securities with varying risk levels to appeal the different investors. This is exactly what Barclays did as a sole structuring advisor for Domino's. Underwriting and distribution. The investment bank then underwrites the deal, meaning they buy the securities from the SPV and then sell them to their network of investors. They are the bridge connecting the company that needs cash to the investors who have it. Advisory. Banks advise the clients on the best way to use securitization to meet their financial goals, whether it's raising capital, managing risk, or cleaning up the balance sheet. By converting illiquid assets into tradable securities, investment banks have massively increased liquidity in the financial system, allowing capital to flow more freely and efficiently than ever before. So what's next? The world of securitization is on the brink of another revolution, this time driven by artificial intelligence and machine learning. Here's how AI is set to change the game. Enhanced risk modeling. Traditionally, assessing the risk of thousands of loans in a pool was a monumental task. AI can analyze vast datasets on borrowers, economic conditions, and historical performance to predict default rates with incredible accuracy. This allows for more precise pricing and better risk management for investors. Automation and efficiency. The process of creating and monitoring securitizations involve immense paperwork and repetitive tasks. AI can automate everything from compliance checks to generating reports, drastically reducing costs and human error. AI-powered trading. Institutional investors are already using AI algorithms to make split-second trading decisions on securitized products based on real-time data and predictive analytics. Firms that fail to adapt to this technological shift will be left behind. The future of securitization is faster, smarter, and more data-driven than ever before. Okay, as promised, here are the two critical factors in securitization that are often glossed over in simplified explanations. Understanding these is the key to seeing the full picture. Servicer risk. Everyone focuses on the risk of borrowers defaulting, but what happens if the servicer, the entity that collecting the payments, fails? If the servicer has poor operational controls or goes bankrupt, it can disrupt the entire flow of cash to investors even if the underlying loans are perfectly fine. This operational risk is a huge, often underestimated point of failure in the securitization chain. Funding risk. Securitization seems like a magic cash machine, but it's heavily dependent on the investor appetite. If market conditions change, as they did during the 2008 financial crisis, funding can dry up overnight. A bank or company that becomes too reliant on securitization as its primary source of funding can find itself in a very dangerous position if investors suddenly get spooked and stop buying. This is why having diversified funding sources is critical. And there you have it. From Domino's to HDFC, from New York to Mumbai, securitization is the DNA of modern finance. It's a powerful engine of the global economy. It's a tool that allows HDFC Bank to strategically manage its multi-billion-dollar balance sheet, ensuring its stability and growth. It's the innovative structure engineered by Barclays that lets a brand like Domino's unlock $1 billion from its future royalty checks to fuel its present. It has fundamentally reshaped investment banking from a simple lend and hold business into a dynamic originate and distribute model, with the bankers as the master architects. And now with AI on the horizon, it's about to get even more sophisticated. But as we have seen, it's not without its risk. Understanding the roles of every player, from the borrower to the servicer, is absolutely crucial. If you want to succeed in finance, you need to understand these deep, powerful concepts. This is what we do over here at Bankers Bootcamp. We go beyond the headlines to give you a practical knowledge of what you need. If you found this deep dive valuable, hit that like button. And for more content that breaks down the complexities of investment banking, make sure you subscribe to the channel. We have got a lot more coming. Drop a comment below with any questions you have or what topics you want me to tackle next. Thanks for watching, and I'll see you in the next video.